Welcome back to the channel, and thank you for joining me. I'm Algabot, your guide to the world of automated trading on MetaTrader 5. Today we're taking a close look at a pure price action expert advisor called Two Leg Pullback Continuation. What makes this one interesting is that it uses no indicators at all. There are no moving averages, no oscillators, and no volume readings anywhere in its logic. Instead, it reads raw market structure the way a seasoned discretionary trader would, hunting for a very specific two-legged pullback before a trend resumes. By the end of this video, you'll understand exactly how it works. So what does this expert advisor actually do? At its heart, two-leg pullback continuation is a trend continuation system. It assumes a market is already moving in a direction, and it waits patiently for the trend to take a breather, correct, and then resume. The key idea is right there in the name. Many traders enter on the very first pullback, but a single pullback often keeps going and turns into a full reversal. This strategy instead waits for a measured correction that unfolds in two distinct legs. In an uptrend, that looks like a move down, a small bounce up, and then a second move down to a higher low. That two-legged shape tends to exhaust the counter-trend pressure, so when the trend does resume, the move is statistically cleaner. Because it relies only on raw open, high, low, and close prices, this expert advisor can be applied to almost any market and any time frame. You could run it on a forex pair like the euro against the dollar, on gold, on an index, or on a cryptocurrency. The logic doesn't change. It identifies swing highs and swing lows using a symmetric fractal window, links them into a clean alternating sequence of peaks and troughs, and then checks whether the last 5 swings form that valid two-leg pattern. Who is this suited for? Educationally speaking, it's a great study tool for traders who want to understand market structure and price action without leaning on lagging indicators. It's methodical and selective by design. It only takes one position at a time, and each detected pattern can only be traded once, so a single setup never fires repeatedly. Remember, everything we discuss here is for educational purposes only, and nothing in this video is financial advice. We're studying how the code makes decisions, not predicting outcomes. Let's walk through the exact logic step by step. First, the expert advisor builds market structure. Every time a bar closes, it scans its stored history for swing pivots. A swing high must be strictly higher than the bars on each side of it, across a window controlled by the swing length setting. A swing low is the mirror image. Those confirmed pivots are then collapsed into a strictly alternating sequence of highs and lows, keeping only the most extreme point in any cluster of the same type. That gives a clean skeleton of the market's peaks and troughs. Next, the strategy examines the last 5 swings, which it labels A, B, C, D, and E. For a long setup, it's looking for the sequence low, high, low, high, low. Here is the start of the impulse. B is the impulse high, C is the first pullback low, D is a lower high where the bounce failed, and E is a second pullback low. 2 conditions must hold. The swing D must be a lower high than B, confirming the bounce ran out of steam below the impulse top. And the swing E must be a higher low than A, confirming the uptrend structure is still intact. When both are true, the EA arms a long setup, with the trigger placed at that lower high, D. The entry then fires on live price. For the long, when the ask price climbs above the trigger D, plus a small entry buffer, the correction has failed and the uptrend has resumed, so the strategy signals a buy. The short setup is a perfect mirror. The sequence is high, low, high, low, high. The corrective dip must be a higher low, and the second bounce must be a lower high. When price breaks below the trigger, the strategy signals a sell. Risk management is structural. The stop loss sits just beyond the protective swing E, the last pullback extreme, padded by a fraction of the impulse leg height set by the stop buffer percentage. The take profit is then placed at a fixed reward-to-risk multiple of that stop distance, controlled by the RewardRisk setting, which defaults to 2. So if the structural risk is 1 unit, the target is 2 units away. Only one position runs at a time, and once a setup is traded, it's locked out so it never refires. Let's read through the actual MQL5 code as it appears in MetaEditor. At the top are the input parameters, the dials you can adjust in the strategy tester. Swing length is the fractal half window. A smaller value detects more, smaller swings, while a larger value only registers bigger, more significant pivots. Reward risk is the multiple that sets how far the take profit sits relative to the stop, defaulting to 2. Stop buffer percentage adds padding beyond the protective swing, expressed as a fraction of the impulse leg height, so a wider leg gives a wider cushion. Entry buffer percentage does the same for the trigger, requiring price to break a little beyond the level before committing. And lots simply sets the fixed trade size. Now the entry logic shown below. The strategy first computes a buffer by multiplying the entry buffer percentage by the stored leg height. It adds that to the trigger to get the level price must clear. It then reads the current ask price. If price is still at or below that level, the function simply returns and keeps waiting. Once price pushes above, the breakout is confirmed. The stop loss is calculated by taking the protective swing basis and subtracting the stop buffer fraction of the leg height, placing it safely beyond the last pullback low. The risk is the distance from entry to that stop, and if it isn't positive, the trade is skipped. Finally, the take profit is the entry price plus the reward risk multiple times that risk, and the buy order is sent with both levels attached. Let's watch this play out on the chart. Because this is a pure price action strategy, the gold line traces the market structure, connecting the confirmed swing pivots that the expert advisor builds from raw highs and lows. Follow the left side first. Price rallies sharply to make an impulse high, our swing B. Then it pulls back to a first low, bounces to a lower high labeled D, and slides down again to a second, higher low, our swing E. Notice that this higher low sits above the original starting low, so the uptrend structure is still intact, and the bounce that made D failed below the impulse top. That's a valid long setup. When the next candle pushes price back up through that lower high D, the correction has failed and the strategy signals a buy. From there, price continues climbing in the direction of the dominant trend until it reaches the take profit, placed at twice the structural risk. Now watch the right side of the chart, where the mirror image unfolds. Price tops out and reverses into a downtrend. It drops to an impulse low, bounces to a high, dips to a higher low labeled D, then bounces again to a lower high, our swing E, which stays below the prior peak. The downtrend structure is intact and the corrective dip held above the impulse bottom. That's a valid short setup. When price finally breaks down through the higher low D, the strategy signals a sell, and price falls toward its take profit below. In both cases, the entry only fires after the two-leg correction completes and the trend resumes through the trigger level. This is an illustrative example for educational purposes only. That brings us to the end of our look at the two-leg pullback continuation expert advisor. We covered how it builds market structure from raw price using fractal swing pivots, how it recognizes that distinctive two-legged correction, how it triggers entries when the dominant trend resumes, and how it places a structural stop and a reward-to-risk-based target. Remember, this content is for educational purposes only and is not financial advice. Always test any strategy thoroughly on historical data and a demo account before risking real capital. If you found this breakdown helpful, please hit the like button, subscribe for more MetaTrader 5 strategy analyses, and drop a comment letting me know which strategy you'd like me to cover next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.